Hi everyone, this is Rob Roy and welcome to the Elliott Wave Elite U.S. Market Update. Volatility continues in the U.S. markets, as you can see from this chart of the SPX. And again, we are in the corrective patterns with the ABCs being labeled with the Elliott Wave tool. Before I show you something that's really interesting with where the markets are right now, I wanted to revisit one of the things that I mentioned last week as far as the fact that the charts have relabeled, or the Elliott Wave relabeled. A lot of people comment about that. Sometimes it bothers people. I think it's actually a great thing. You have to remember that the markets are dynamic and you need to be able to change with the markets. And we had this wave 4 forming, and one of the Elliott Wave rules is if the wave 4 comes down and violates the wave 1 high, then you will relabel. That's just one of the rules. So we're just simply following the rules. So as the market comes down, see, violated the top of that wave 1 and the chart's relabeled. So simple as that. Again, just wanted to respond to some commentary from last week. But finishing up the charts to show you where we are currently, which is fascinating. Remember, we talk about not just the 5-wave Elliott Wave patterns, but the 3-wave corrective patterns. We focused on them an awful lot. If you're fairly new, go back and watch some of the past recordings, flats, zigzags, and triangles. Now watch this with the downward move. If we use the Fibonacci tool, and Fibonacci goes hand in hand with Elliott Wave, as you know, from the start of this downward move, you can see that we went to exactly a 50% correction. So we had our impulse move to the downside, then we had a perfect 50% correction, and if you know your zigzag rules, where's the extension supposed to be? On a 50% correction, you're supposed to have a 100% fib extension. So let's use the fib extension tool and follow along with that. And lo and behold, where did we go? Right to the 100% extension. So from that standpoint, the market actually could find a little bit of stability here. If we don't, where are we going? Well, we're going down to an extended C wave of the zigzag pattern, which would be down to the 161.8 level, or approximately around 2,500. So to condense the chart up just a little bit and show you where we were before, we're also right in that area of the previous lows. So if we take a look at the lows from April, look where we are. Exactly at that 100% C wave extension, and exactly where we found support back in April. So a lot of things going on that could provide some support in the market right now. The bounce that occurred in today's trade is not unusual for either one of the two scenarios. The two scenarios, again, being that we find support here and begin to head back up, or that we go down to an extended C wave. And the reason that I say that is when you have an extended C wave, the common protocol is you go back and test at least the previous fib level. In other words, coming down here to the 100% extension, we should go back up and test that 61.8% extension, which we're almost there now, before heading down to the extended level. So regardless of whether or not we're finished going down or not, this move back to the upside and back up to that 61.8% fib level is quite warranted. So let me clean this up, and then I'm going to go ahead and draw in the lettering for this zigzag pattern that occurred here within the overall corrective pattern. Remember, you have waves within waves. It's all part of Elliott Wave, and that's why you can trade on a shorter term basis within Elliott Wave as well as the larger patterns. Once you get good at it, you don't have to just wait and sit back and trade only the big patterns. So there's the zigzag. Now again, it's complete. It did it. It did everything it was supposed to do. We had the 50% correction. We went back up, hit that level, and then we had our extension down to the 100% level. Just as classic as it possibly could be. Now, one last thing that I wanted to put on there are the moving averages. So if we take a look, this lime green line there. I know the chart's getting a little bit busy, but I kind of like it when we have all this stuff on here. But right there, we're not too far away from that, so that's intact. In other words, we don't need to move up, down, or sideways. As far as the 10-day moving average, one of my rules, if you haven't heard it before, is no security in any time frame gets very far away from its 10-day moving average. It just doesn't happen. When there's a separation, they will come back together. Whether the market moves sideways to allow the moving average to catch up or the market goes back to the moving average, those two will always come back together. Then the 200-day moving average is this red line, and note that we're trading below it. There's a lot of talk in the markets that we're in a correction, but are we going into a bear market, etc. In my opinion, once you break below the 200-day moving average, you're in a bit of a bear market scenario, and we need to get back above that 200-day moving average, or again, in my opinion, we're looking for more downside potential. But if we bounce back up and get above that 200-day moving average, that changes everything. So just things to think about as we move forward in the markets. But isn't that amazing? Did exactly what it's supposed to do. And so at this point in time, we watch for the 61.8% level to be hit, and then it gets interesting. Do we go up from there, or do we turn down and head back? But that'll be a great trade once that shows its head. Looking at the SPY to bring volume into the mix, as you would expect with this volatility, the volume is increasing. And remember, we noted that it was unusual when we had this bounce up here that volume didn't fall off. Usually when you start to consolidate a bit, the volume falls off, and we bounced up and the volume increased. That was just a little bit of a nod to the fact that we were going to be heading lower, and it's exactly what happened. Looking at the VIX, and we put the Elliott Wave on here. We noted last week that that was a little bit, it's not concerning, because if as an options trader, it's fantastic. You want the volatility, but if you're long only the market, then you're probably not too crazy about this upward wave 5 Elliott Wave pattern that shows that we are not done with the volatility yet. So if this pattern holds, then you would suspect that there's a good chance we are going down to that 161.8% extension. Now think about that for a second. So if I go back and look at the SPY with the volume, yeah, we've had a lot of downside, and yes, we've had increased volume, but we haven't had that flush out, just the volume that scares the heck out of everybody, the panic selling, the point where you get to when normally you see the markets turn around and go back to the upside, scares the crap out of everybody. And that's usually when a bottom's put in. We just haven't had that kind of volume. Doesn't mean we have to have it, but quite often you just get that, I just call it a flush out, just where everyone who wants to sell panic sells, and then at that point, then the smart money steps in, and we start a new impulse pattern back to the upside. So wouldn't that kind of tie in together? If we do come down to this 161.8% level, we break those lows from February and April that we just talked about, that would certainly create that spike in volume that I'm talking about, and then that could be a potential full bottom. But again, we're at a support level. It doesn't have to do that, but when you look at the VIX, and it shows that in the Elliott Wave 5 pattern, we're likely to have more volatility. Those kind of all line up. So we'll see if that plays out. But boy, nice breakout, just exactly what we were talking about all the time. I've shown you this a bunch of times, so I don't need to keep doing it, but it is just fascinating, and I love this stuff. So we had this huge descending triangle, and it did exactly what it's supposed to do again. So the markets, you've seen it with the results of our case studies. The markets, they really do fall in line with Elliott Wave. It's an outstanding predictor. If you haven't renewed your data for Private Source or Integrated Investor, boy, now's a great time, because with this volatility, there's so much money to be made on these case studies. TBT, I'm going to save this one right now, because that's going to be one of the case studies that I'm going to talk about. So we'll come back to that in a second. For now, looking at MasterCard, one of our current case studies, we did break down a little bit further, but look, the wave 5 is only at a 31% correction. It hasn't even hit the 38 6% correction level yet, 38.2%. I mean, which is the level that I really prefer as the first main level of support on a downward move. 23.6 to me isn't that strong of a level. 38.2, then 50, 61.8, etc., or the main levels to watch. So this is still intact. We're still in a longer-term Fibonacci correction in the wave 4 and an Elliott Wave 5 back to the upside. So we haven't even hit that fib level that we're looking for in the wave 4 yet. So still in good shape there with MasterCard. Wanted to show you Baidu because we talked about that one too. Coming down, we already closed out our case study and took a nice gain in this, but look, it did go all the way right down to the bottom of that wave 5 box. And hit the very bottom of it. We talked about the fact that that might happen, and we may just go on down to 100% extension now. Is very likely that that's going to occur. But I did want to be clear that we are already out of our case study, took the profit. So you take a nice gain and move on. But just because it did what it was supposed to do, I wanted to share that with you. All right, back up to TBT, which is what I want to talk about as far as our case study this week. I think you can clearly see the triangle that we have in interest rates, and this is fascinating too because we have the market at the support level. We've talked about the potential moves up or down with the market. Put the Elliott Wave pattern on, you can see that according to the larger Elliott Wave pattern, you would think that we're going to get an upside breakout, and it's accurate as the Elliott Wave larger patterns are. When I see a triangle like this, I personally turn that off because with these triangles, the rules are it can go either direction, and if you have a well-formed triangle and you pick a direction, you're violating the triangle rules. So let's see, because as we know, if we do get a downside breakout and we violate this one here, that'll relabel anyway. So we'll just see how this plays out. And think about this. What are the two scenarios here? Well, if the market moves to the upside, so we find support here at this 100% extension, and we do start a new impulse move to the upside in the market in general. Well, based on what's going on with the Federal Reserve, etc., interest rates would probably start to climb back to the upside, especially with the concerns about inflation, etc. So we will likely move back up if the market moves up with interest rates. So that's a scenario for an upward breakout from a fundamental standpoint for those of you that like fundamentals. For a downward breakout out of TBT, it could be that we do break down, we do head down to this 161.8% extension, scares the crap out of everybody like I was talking about, and money panics and it moves into bonds. How do bonds work? As prices go up, yields and rates go down. So if the prices start to go up, rates will go down, and this will move to the downside. So that could be the scenario, the fundamental scenario for a downside breakout. I'm a technical trader. I love to focus on technicals. I think it's the more accurate way to trade, but putting fundamentals in there is never a bad thing. It's just I prefer the technicals to be supplemented by fundamentals. And so that's what I wanted to share. So we sent out an alert for a strangle, the Delta strangle for TBT in December with 42.39 strikes. So we'll see how that plays out in the next couple of weeks. But boy, fascinating time in the market to see which direction we go to from here. Hope you've had a wonderful week, and we'll be back to talk to you again next week. Take care, everybody.